Thank you for the nice introduction. And I guess I have to stop doing so much so I can make my bio a little shorter. And I want to start off by thanking the Armed Services YMCA San Diego for hosting this, and with Anna and Tim, and Guaranteed Rate, our sponsor. It's been an honor to serve our valued armed services members, and because my father was in the Air Force, and so I know that a lot of families, especially the wives as well, the sacrifices that you folks make, I don't take it lightly, and this is my way of giving back, and I appreciate you deeply. So thank you for your service. So today's going to be a little interesting. So I normally, when I do a workshop, it's about an hour and a half. So I've condensed it to about 25 minutes. And once again, if you could just send any questions to the chat log, that'd be great. And then Anna will read it off at the end. And you're going to learn a lot today. Because you guys remember Charlie Brown, the comics, right? So remember that the teacher, up in the wall, wah, 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 and you're going to sleep, right? So I promise you, you're not going to go to sleep with this. You're going to learn a lot. When you apply the techniques I'm going to show you today, and these are things you're not going to learn in school or on the internet, I know that the average client who does this, that's making, let's say, $100,000 or less a year, is saving at least $300 to $600 a month in interest. Okay. And so this right now, there's been some reports out that in the last week, because of the economy, with gas prices and oil prices and groceries going up and expenses, the average household spending right now about $250 a month more currently. And unfortunately, I think it's going to go up a little higher. So this will more than offset what we're currently going through in our economic status. Okay, so it starts off with CIQ offers the most trusted credit solutions. After our coaching today, you're going to more than what 95% of the population knows about credit and how to effectively leverage your scores to build wealth for a lifetime. And what I mean by helping you build wealth is, once you achieve a 740 or higher score, you can then demand a 0% rate on a car loan for a new vehicle, except for Tesla. They're the only ones that don't do that. You can demand a 9.9% fixed rate on credit cards rather than 18 or 24% variable. You can demand a cheaper car and home insurance premiums as well, and usually free up another $75 a month, $85 a month, right? And then the savings for a car is usually around, going from, let's say, 12% interest down to zero on a $25,000 car. Once you break the 740 lender score and getting the 0% rate, it's usually about $175 a month interest saving. So that's where I'm coming up with those numbers. And of course, if you're doing a home loan, which is the fastest way to create wealth, or refinancing it, going from 2.75 or 3%, up to, let's say you've got a 760 score, getting that rate, and then compared to a lower credit score at, let's say, 4% or 5%, that's an easy $200 to $300 a month on your mortgage payment on a $300,000 house. Okay, so that's where I'm coming up with those numbers, just so you're clear. This is an outline of what we typically do when we're coaching a couple. I'm not going to have time to go through all of these bullet points, but this is kind of give you an idea of what we do when we're doing one-on-one coaching. So we cover what's important for you to learn, and then also your personal goals over the next 5 years and the timelines you'd like to achieve them, whether it's buying a home or a car or refinancing things. Help you create a customized written action plan to help achieve your goals faster. How the Fico scoring system works, we will cover this today. Who uses it and how to leverage it to build wealth with your coaching systems. How to read the credit report and find the real lender score. And on that note, did you know that, Anna, I'm going to put you on the spot here for a second. Did you know that Credit Karma and scores you get from your credit card company, consumer credit scores, did you know that those are fake simulated scores? They're not real. Were you aware of that?
I did not know that. No.
Now you know. And generally, thank you. Generally, they're 20 to 60 points higher than what the real lender scores are. So the easiest way for you folks to know what your real score is through a bank. And if you're not spending at least 30 to 50 bucks for that report, it's typically not ever real. All right. If it's free, it's definitely not real. All right. That's the easiest way to tell. So the only way you're ever going to see the report is through, for example, like through Guaranteed Rate or sponsor, or you have a connection with the bank that's going to provide that. Most banks don't want to share that with you, but those Credit Karma scores, they're not real. All right. We'll review how we can remove negative information and improve your scores. We won't have time to go into that today, but that's part of the process. When and how to negotiate with lenders and insurance companies. Remember how I taught you a moment ago that once you break the 740 lender score, the real score, then you can demand these lower rates or 0% rate, right? So that's kind of a little bit of an outline. So we're founded in 1990, and we are the oldest in the industry doing the forensic credit restoration and financial coaching in the United States. We're the very first ones to be doing the combination of the two. And we work by referral only with financial service professionals like Guaranteed Rate. And we haven't advertised since 1992. So hopefully that says a lot to you. And we're the only company that electronically interfaces with the bureaus directly for faster and more accurate results. So everything you've heard about credit repair, erase that. That's not what we're doing. It's too slow. And you hear horror stories often how they get something off and it comes right back. That's not us. We use what's called forensics, way different process. So this is the beginning of the coaching. So a credit score grade. So where's your score, right? So 850 is as high as you can go. But once you break the 770 mark on the lender score, not the fake ones, but the real ones, then that's one of the highest tiers you can get at. Now for clients that are doing, for people that are doing what's called jumbos or super jumbo home loans in the future, let's say that $729,000 or above, for example, I really want you to push for 770 or higher. Okay. If you're doing loan amounts below this in the future, then 740 plus is perfect. Okay. Now with a 740 lender score, you get better rates with faster approval times. And if you're buying investment properties in the future, because once again, that's the fastest way to create wealth, you've got to have a 740 or you're toast, right? Because instead of putting 20% down, maybe it's 30, 40, 50% down, right? And the rates are worse. Now, if you want to demand a 0% rate on a vehicle, as I mentioned earlier, you need a 740 or higher lender score, except for Tesla. They don't play that game. If you want to demand 9.9 fixed rates on credit cards, 740 or higher. And a cheaper car and home insurance premiums, once again, 740. So to me, if you haven't looked at what a real lender scores are, you need to find that out. And then if you're below 740, that's the danger mark. That's when you're spending more money and interest than you should be. Okay. Now, if you folks decide that you're going to open up a small business someday, after you leave service, then you need to be in business for at least 2 years and have at least a 720 or higher lender score to get a line of credit. Let's say it's $50,000 line of credit or $100,000 line of credit. You need at least a 720 or higher score. So if you're thinking about opening up a small business someday, this is your minimum target there, 720 or higher. If you refinance a home and you pull cash out to pay off debt, put in a pool, things of that nature, you need at least a 680 or higher. And because of COVID, I know we've got a few folks with Guaranteed Rate in line with this. They can probably concur with me that because of COVID, a lot of the banks have raised the thresholds to, instead of a 680, some banks want like 700. They've raised it because of risk assessment. If you do a refinance, no cash out, you're just trying to drop the rate and drop the payment. These are conventional loans, by the way, not VA. You need at least a 660 or higher, preferably. If you're doing solar financing, it's typically 660 or higher. If you're doing a purchase, FHA or conventional, 640 or higher minimum. But the higher the score, the better the rate. And then VA goes down to 580, and then anything below 580 is traditionally private money, hard money, which is usually very high risk loans. I don't suggest people buying real estate in the future to dabble in that hard money, private money, because they're very risky. Okay, unless you know what you're doing, you're buying it, you're flipping it quickly. So is that helpful, folks? Kind of seeing the lay of the land, how the system really works? Okay. And if you have any questions on that, once again, put it through the chat log. Now, this is how banks, employers, and insurance companies actually assess risk. So it says, as a group, consumers in the 700 to 749 range have a delinquency rate of 5%. This means that for every 100 people in this range, approximately 5 will default on a loan, file for bankruptcy, or fall 90 days past due on at least one credit count in the next 2 years. So for example, let's apply this to, let's say you're leaving the armed services and you're going to do a civilian type job, right? Or maybe you're going to go in to work for guaranteed rate, because I know they got a recruiting system where you can actually start doing loans with them. That could be a career path. So when you start to look outside the military, for example, and you're trying to get a job, then they look at your credit scores, right? And most of you folks on the line know that if you're doing your security clearances, they also look at your scores for risk assessment. That's another big thing. So let's say there's one position available, and you've got a 620 lender score, and then Susie's applying for that same position, and she's got a 700 score. Well, what they're doing is they're pulling your scores for risk assessment, and let's say they hire Susie because what they're saying is there's a 31% chance that you're going to be late for work, call in sick, or have lack of focus on the job because there's a life event going on. Now, they're not telling you, hey, we hired Susie because, her scores are better, because they don't want to get sued. But I know they're doing this stuff, right? Especially the Fortune 500 companies. Now, if you're working for 7-Eleven or something like that, they're probably not doing that unless you're doing a management position. But this is what's going on right now. And it's been happening for the last decade. And in the last 4 years, they're now using it not only for hiring people for decisions, but they're also doing it for promoting people now. Okay. So this is a big aha moment for most people. Okay. So this is a breakdown of the formula. So payment history is 35% of the score. Now, we all know a late payment can drop a score, but most people have no clue at what degrees. So it says any new late payments, collections paid or unpaid, which we'll talk more about that in a moment, or bad debt charge-offs of any type will drop a score as much as 107 points. Even one new 30-day late payment of $5 can cost you the loan you want and the credit score you deserve. So in fact, the lower the minimum payment is that's due, that you're late on, the further the score will drop, as it assumes if you can't make a smaller payment, you're in serious jeopardy, and then the score dramatically drops. So that's actually how it works. The smaller the payment is that you're late on, the further the score drops. I bet before I taught this to you, you thought that, well, maybe the larger the payment, the worse it is. No, it's the smaller the payment. And it makes sense once you think about it, right? So let's talk about collections and bad debt for a moment. Most people think, well, hey, I'm going to go buy a home or get a job promotion or get this loan. I'll go in there and I'll just pay off all my collections. Well, unfortunately, how the Fico works is that when you pay off a bad debt, they don't delete it off your credit report. What they do is they put paid or settled. And once they do that, it re-ages it and it drops the score. It doesn't raise it. It's counterintuitive. Okay. And just so you understand the mechanics behind this is that FICO, the credit formula, it was developed in 1956 by Bill Thayer and Earl Isaac. They were mathematicians and they were hired by insurance companies. And then, so insurance companies have been using this far longer than lenders. And then they said, well, hey, I bet we could sell this to banks now. And then they created FICO, and that's how it all started. So FICO looks at the algorithms and it says, if you pay off a bad debt, there's a high probability what you're doing is you're taking your savings or your reserves to pay that off. And it has no way to calculate whether you have $1 million or $1 in the bank, right? So what it's assuming is since you're depleting your savings or reserves to pay off this bad debt, it's going to drop the score, not raise it. Because that way, if you're sick and you can't work a couple paychecks and you just hypothetically depleted your reserves, what's going to happen now? You're going to start being late on other accounts now, aren't you? Right? So that's why it drops it. It doesn't raise it. You won't find this information on the internet anywhere. Okay. So one little 30-day late payment, drop it, 100 points, instantly gone. Okay. So what we'd rather do if you've got bad debt is have a meeting, do a forensic analysis on the report and your financials and figure out, is it possible to remove this without us paying on it? Okay. And one thing you'll learn about our firm is that we'll always tell you the truth, not what you want to hear. And the truth is we're good at what we do. But we're not Jesus. We don't got water. And so some things we just can't get off without you making a deal with them. So if and only if we need to bring our attorney in and settle it for, let's say it's $1,000 debt, and we settle it for $300, which is our average settlement, 30 cents a dollar, then we'll settle it. And then we'll come in behind it and then start working on the paid collection, right? Or maybe if you're doing a home loan, if the lender said, well, hey, we've got the score we need to fund, but would we like to get higher in the future? Yes. And refinance it later and save more money? Yes. So let's just resolve the bad debt, prove to the bank that we've resolved it so you get the loan, get funded. Then we go in behind it, start working on removing the paid collection. And then once you're above 740, then you refinance everything. That make sense? Baby steps. All right. Now, these next two slides are the most important two slides I want you to memorize and apply the rest of your life. These are very powerful. Amount of debt is 30% of the score. So we call this the 30% rule on credit cards. So this only applies to revolving debt, store cards and credit cards and lines of credit. So what you do is you look at each credit card limit and subtract 70% from the credit limit amount. This will equal 30% of available credit. So if you have to use the line of credit or the credit card in an emergency, just don't ever exceed the 30% mark. So let's say you've got a $1,000 limit. Don't ever charge over $300. That's 30%. Make sense? Okay. So a zero balance on the lender's report gains the most points. Every dollar that shows up in the balance column, it takes away points. Once it hits 30%, it dramatically drops it. So that's how the game's actually played. Now, to go a little deeper, it says, because you may be saying, well, I pay off my credit cards to zero every month. I'm okay. Wrong. This is how it really works. Creditors report data to the bureaus every 30 to 90 days, which is the key point. Randomly throughout the month, whether it's the 1st, the 15th, or the 30th, when most people carry a balance. They do not report what you paid that month on the statement, but rather what your current balance was, a snapshot in time as they upload the data, thus driving down your score. So that's the dirty little secret. They're not reporting what you paid it down to. They're reporting what did it look like the day they upload, and we don't know what day they're going to upload, do we? Right? Okay. So ideally, if you're ever going through a financial crunch, and you can't afford to pay them off every month, right? And hopefully we can get you out of that, that rabbit trail here, right? But worst case scenario is your fallback, pay off all the cards to zero balances 90 days prior to applying for anything, home loan, car loan, credit card, job promotion, things of that nature, insurance, right? And then you lock the credit cards away in the safe after you paid them off, sit on it for 90 days, and then you let them pull the report. That will be it'll upload a zero balance and maximize that score. Does that make sense? That's your fallback position. Okay. All right. So here's the next piece. It kind of dovetails into this one. Length of credit history is 15% of score. The longer your credit cards are active and open, the better your score will be. And I'm going to pick on you again, Anna. How many credit cards, for your understanding, and you're pretty smart, I've spent a little bit of time with you, you're a sharp cookie. How many credit cards should you have? A minimum. How many minimum credit cards should you have? Do you know? Take a guess.
2.
3. Good job. So you need at least 3 or more active, open, good revolving cards that are active, open, and current, greater than 12 months old. All right. Without that, it's very hard to get up in the high 700s, if almost impossible. It's very hard, right? Unless you've got a credit file that's like 20, 30, 40 years old, right? With other trade lines going. Okay. So you need 3, folks, right? And if you need direction on where to go get those other cards, then, we can help you with that too, right? It's helping you rebuild your file. So it says, do not ever close a credit card. Because if you do, this will cause you to lose all the good history you've built on those cards. Instead, keep the card open, only make a $5 purchase or a cup of coffee once every 5 months to keep them active. A zero balance credit card goes inactive after 6 months of non-usage, which will do what to your score? It'll drop it, right? So the definition of an inactive card is any open cards with a zero balance that hasn't been used in 6 months is considered inactive and will drop the score. Charging a small amount on the card every 5 months, such as $5 or less, a cup of coffee, then paying it off when you receive the statement will help the score increase within 30 to 90 days. This is the key point. Stimulating activity and ensure the creditor doesn't close them from non-activity. And if they close it because you haven't been using it for, let's say, a year, it could drop it 100 points. One card, close, 100 points, gone. All right. So I know for you guaranteed rate folks are on the line, I know you've seen this before because you guys are pretty seasoned, right? So that's a big takeaway. All right. So don't ever close them. And now, if you're wondering, well, Don, why did you say put $5 in the card every 5 months, not 50 or 500? Well, here's a very good reason for that. Two reasons. One, $5 is easy to pay off, right? And two is we don't know when the lender is going to upload the data. So even if they upload a $5 bill because you're catching it off cycle, it's not really going to drop your score much. That's why. Okay. And then you also notice here, it says pay it off when you get the statement. So if you charge on it today and you pay it off tomorrow, it like Macy's, Capital One, I don't keep track of them all anymore. Some of these creditors, if you charge on it and pay it off before the statement comes out, it'll look like it's going idle and it'll start dropping your score. So wait till you get the statement, pay it on that day, not before. Okay. Now you guys have heard, hey, if I do an authorized user on my Uncle Joey's card, it'll help my credit. You guys heard that? Well, up until 2008, when the market collapsed, everybody was pointing their fingers. Oh, it's Wall Street. It's the mortgage bankers. It's everybody's fault, right? So Fico got wind of the credit formula, got wind that people were gaming the system by having you placed on Uncle Joey's credit card they've had for 20 years, right? To build up the file. So they rechanged the algorithms. They never announced it to anybody, but I know they did it in 2011, where the authorized user card trick doesn't work anymore unless you've got no derogatory data. So if you have one little blemish, a 30-day late from 6.5 years ago, let alone a paid collection, if there's any blemishes at all, they know you're trying to game the system and they will not give you a score bump. It doesn't work anymore. Okay. If you're clean, it will work, right? But you still obviously need to eventually get 3 of your own cards. But this trick is healthy. If you're maybe younger, and you're trying to build it up, you maybe get one credit card going and then have, your mom or dad or Aunt Susie put you on, let's say, an old Sears card they've had for 20 or 30 years. The older the cards are, the more points you get. Okay. And not all the creditors do it anymore. So you have to ask them, hey, if I put on my Uncle Joey's card, will you report this to the bureau? Sometimes they'll say, no, we don't do that. So then you move on. Okay. So once again, to be clear, this will not help with your credit if you've got any blemishes on the credit report. Okay. New credit's 10% of the score. New open accounts drop your score for a year. And now the reason why it drops your score for a year when you open up a new car loan, home loan, credit card, whatever, is because FICO says, well, until you can prove you can handle this new debt, we're going to take points away from you. And as long as you weren't late on the 12th month, then we'll give your points back and give you a little bit of a super boost, maybe 10 or 20 points. So it's very dangerous to be opening accounts 1 year prior to an event, buying a home, getting a big job promotion, whatever, right? So you really have to be critical thinking on your planning. Okay. If you're doing big ticket items, you shouldn't be really opening up trade lines 1 year prior to that event. You want to do it. Does it make sense? Okay. So it says inquiries can drop your score an average of 2 to 3 points. So at the bottom, it says 2 or more inquiries within 90 days can drop it 5 to 22 points. One inquiry can drop it within 90 days, can drop it 2 to 3 points. So it's very small. Now, the good news is your points are returned within 90 days of each inquiry. You get your points back, right? The more inquiries you do within a 90-day period, the higher the score loss. Again, please consult with a professional first before you're doing anything, okay? Then finally, types of credit is 10%. There's a hierarchy as far as credit weighting. Now at the top, we have mortgages have the greatest amount of weight and good, bad things happen to them. Then it's auto loans. And then now notice here, it says, do not pay off in less than 2 years. Otherwise, what will happen? It'll drop your score 30 to 60 points. A lot of people that we're coaching are like, hey, we're going to just go pay off this car loan. It'll help us before we do this event. I'm like, not a good idea. If it's less than 2 years old, right? You'll go backwards, right? A better idea. Let's say you're buying a home. I know, like guaranteed rate, for example, as long as you've got, I think, less than 10 months of payments left, then they don't even count that as far as your debt to income ratios. And I could be off on that, but so my point is, paying off a car is not really going to help your score much. Is the point as well? Okay, it's not as much. You get more points on paying off credit card debt to zero than you would paying off a $50,000 car, for example. Okay. And plus the interest rates are higher on credit cards than usually on a car. So if you're leveraging your money. Now, revolving lines of credit, such as bank cards and store cards and other installment loans, such as student loans, have the least amount of weight when it relates to the balances of the debt load. So what this means to so many of us Americans that are buried in student loan debt, I think it's a national epidemic, is you're probably thinking, well, geez, if I'm going to have to pay off my student loan debt to get my scores to go up. Well, here's the good news. It's not really affecting your scores. Now, if you're late on it, that's a different story, right? But as far as the balances, I've got doctors that are trying to buy homes, for example. We're working on their credit coaching and bringing their scores up, getting ready for that. And I've seen doctors pay off $500,000 in student loans in one day. And you would assume the score would skyrocket, right? It only went up 3 points. That's it. $500,000, just to show you how little weight the balances of debt loads carrying for student loans. So that's a big relief for most of you viewers, I'm sure. Okay. And it says a mortgage loan carries more positive points after being open for greater than 12 months compared to any other type of credit. All right. So as far as rebuilding your credit, it says it's important that you do your part to ensure that no more new derogatory data appears on your file if you decide to hire us to clean it up. And then adding positive credit while we remove the inaccurate, unverifiable, and obsolete derogatory data make your score climb higher. Okay. So I don't have time to go much deeper into the algorithms with you. I'd be honored for you to and your significant other and your family we'd be honored to serve you and your family to help you build wealth. And so we're not living paycheck to paycheck as well. I'll show you a different way. And so, when you contact us for more information, you get, and just let my team know you've got a discount code with the Armed Services YMCA San Diego. And typically it's $300 that we charge for a 3-hour coaching system, including a copy of the report. But we're waiving that. And you guys just cover the cost of the lender's report, which costs us $50, and we're fine. We don't mind donating our time for this, because you and your family are important to me. I want to give back because you're serving us so well. So, and you'll receive up to 3 hours of coaching and a copy of a lender's report with the real scores. And it's a soft pull, and it won't drop your score. So we paid a little extra money on these reports for you, so it won't create an inquiry, and it will not drop your score. And we'll give you a copy of that in the web meeting, right? And it's not the fake Credit Karma consumer scores we talked about. And including with that, you can get a written action plan customized just for you and your family members to help you quickly achieve your financial goals. So that's all included for $50. All right. So it's a little item of value. And so there's a couple ways to engage with us when you want to go through the coaching. You can text the word credit to 72,000. That's one way. If you want, you can take a screenshot with your phone of this meeting. And then you're going to get a little text back with this little Mobit link. You click on it, and then a calendar will pop open. Just pick a 5-minute slot for Grace to call you, time and day. She'll look at your calendar, look at my coach's calendar, and then we'll go through the coaching session, okay? Or you just click on this Calendly link right here if you're able to access it. Or if you're kind of like me and you got to have your 2-year-old kid help you with this kind of stuff, and you just want to pick up the phone and call, you can call Grace directly at 925-269-4033. All right. And then in addition, once again, I wanted to thank the Armed Services YMCA San Diego for partnering with us on this, and then Guaranteed Rate, our sponsor. And if you have any mortgage questions, you can even also contact Paul and his team at 808-339-3922, or there's his email right here. Okay. And the amazing team. I've been working with them for many, many years. You'll be very impressed with them. And most of them are ex-military as well. So, all right. So with that, I'd like to open it up for any questions that you may have. We just had a new person just log in just now.
I have a question. Don, question?
Yes, sir. Yes, sir.
Okay. So you mentioned that sometimes paying off the collections will not raise credit scores.
Yes.
My experience has been that sometimes it will. I mean, not all the times, especially if they're charge-offs or something like that on credit cards, right?
Yes.
And sometimes as much as 30 or 40 points. And what's really amazing, though, is that you can have, for lack of a better term, credit repair on an Experian report and do the same identical repair and have the points go up, maybe let's just say for sake of discussion, 25 points, and then do the same repairs on an Equifax and have them go down 25 points.
Yes.
And then TransUnion will mirror Experian. Can
Yes.
you shed some light on, I mean, is it just the algorithms that Equifax has as opposed to TransUnion Experian?
Yeah, Gary, you must be seasoned because I've never had that question, but I love a challenge. I will answer that for you. I've never heard anybody ask that before. The reason why you're seeing very weird anomalies sometimes with your credit scores is because every creditor reports at different times of the month, correct?
Right.
So you may, on the surface, it may look like, oh, this score went up with these two bureaus, and why did this one go down? Well, it's because maybe that one hadn't updated completely yet, right? Or maybe that bureau, or maybe it's because Macy's uploaded to the other two bureaus that
Right.
that there was one of the credit cards was paid off, but the third bureau is still showing the balance because it hasn't uploaded through their tapes yet, right? So on the surface, you're like, well, this doesn't make sense. Why did but that's usually where I go. That 99% of the time, that's the main reason why you're seeing a huge difference on the updates. Does that make sense?
Yes. And there has been times when we've had people add a card, and believe it or not, because they added a card, even as little as 30 days, their scores have increased. But like, you said, that's just because they have no other credit. And, I've always told my clients that, credit is like a muscle. If you don't use it, it atrophies, and you need to use it.
That's right.
So
good. I'm going to borrow that one. That's the highest form of flattery. I'm going to borrow that one.
You can
That's a
have
good
it,
one.
man. You can have it. But so, in sitting here listening to you, and this is not a line of BS. I mean, I sincerely appreciate what you've given us, because
Amen. You're welcome.
No, because it really helps, solidify where we can go. And it's always going to be nice to, have somebody that if they really need, serious credit coaching, that we have an avenue to refer them to. That's not going to charge them an arm and a leg. As well as I do, there's these credit repair companies out there. They'll charge them $200 or $300 a month and stretch it out over 5 or 6 months.
It's putting them further in the hole.
Correct.
Yes, exactly.
So
yes.
I just want to say thank you. And
you're welcome.
And to Armed Services, thank you guys as well for allowing us to be here for this. We really appreciate it.
Of course. You're welcome. Thanks for joining.
Great. Thank you, Gary. I appreciate you, brother. Was there any other questions in the chat log?
That was it from the chat box. And I shared basically this slide with the Calendly link in there as well. So you can follow that directly if you're interested in booking something. Yeah, I learned a lot as well. So thank you so much, Don.
Oh, you're welcome. My pleasure. That means I did a good job with my presenting then, if you did a lot of questions, or did a really bad job, one of the two. It's one or the other.
Well, actually, we just want to thank Grace for giving you all the notes that you had to read. So it was really Grace that did it for you. We know that.
Ah, yes, it's true. She is my shoestring of bubblegum. She helps me keep it together. And we also have a bilingual team too. So if you have your family or if your family members would prefer to do it in Spanish, then hey, we're there. We're there. We're all in, because like I said, I can't say it enough times. I come from a military, family background. I know how much sacrifice you folks have done. And I just get such joy knowing I'm giving back. So thanks again for your service. Thank you again to Anna and Tim at Armed Services YMCA San Diego, and also Paul from Guaranteed Rate and the Guaranteed Rate team. So that's all I've got for today. God bless you. And
God bless.
you know,
I want to jump in really quick. My apologies. This is Tim, Armed Services Y. As I mentioned earlier, I was an enlisted Marine and, been through many financial hardships and many financial successes. And it would be great to have the Guaranteed Rate team and yourself on my side as I traveled through my life. And I'm so appreciative of you being here now and thankful for this partnership. So thanks for that.
my pleasure, Tim. My pleasure. All right, folks, that's all I have for today. You be blessed and go take that knowledge I just gave you and put it into action. All right.
Yes. Thank you
Okay.
so much, everyone. Have a great day.
Thank you, Don.
Thank you. You're
Thank you, guys.
welcome.
Bye-bye.
All right.